Welcome to another episode of Back and Forth with Blue Ridge Wealth Planners. My name is John Vandergriff. I'm one of the owners and wealth planners at Blue Ridge Wealth Planners, and I'm joined as always by Zach Hill, who is the operations team lead, also the portfolio management team lead at our team. He does own Remedy Coffee, just to throw that in to keep this good and consistent with really every episode that we've ever had. But Zach is going to share with you a little bit of what he's been looking at as the portfolio management driver of our company as we look at our topic today, which is just the current state of the economy. I think this is going to be something that we try to do, I think, a couple times a year at minimum, just so that we can, hopefully clue some people into what's going on bigger than just broad market results and different things. And obviously, with this year being all over the place in different places, I think it is good moving forward to just get a current snapshot of what's happening and maybe some opportunities, but also, what to look for as well. So with that being said, Zach is going to drive a lot of what we're going to talk about today, and then we'll, again, go back and forth on the topic of this economy and see kind of where it takes us. So, Zach, if you want to go ahead and take the wheel here.
Like you said, we want to try to do this a little bit regularly from now on, but this one is especially timely just because of everything that's happened in the country and the economy this year. I think we've seen headlines and GDP figures or specific points of economic data come in that are just crazy. I've said this a lot of times, and this is the best way I know to describe it, is it looks like an error when you see these numbers. When you see a lot of these numbers happening, and you saw it, March really when the pandemic started to now, a lot of these things just don't look right. And so really diving in and seeing what's actually going on under the hood in the economy and what are some good, we actually have seen some strong points in the economy and a lot of weaknesses, obviously, over the last few months. And so I'm going to dive in a little bit into that as we get in here. But the biggest measure that we look at when we look at the economy is GDP, which is gross domestic product, which is just a measure of all economic activity. GDP was really invented after the Great Depression. So a lot of what I say when I say worst since GDP was invented, it was after the Great Depression. But what we saw in GDP this year was Depression era numbers. We saw the second quarter GDP shrank 31%.
Right.
That is so far and away worse than any number that we've ever seen.
Yeah.
And so that's just the broad measure of economic activity. And if we kind of saw that coming in real time. We knew that in April and May and June that economic activity was going to be bad because nobody was leaving their houses. We weren't going out to eat. Restaurants were shut down. Oil was in negative territory because we stopped driving, so there was just no demand for gasoline. There was no travel. I mean, airlines stopped flying for a little bit. So we saw all of those things come to a pretty abrupt halt, and that's really when GDP took the biggest hit. And so there's a lot of reasons for that, but it was the most common sense thing in the world whenever you saw it. You're like, well, nobody's doing anything. The one place that people were spending money was Amazon. And we saw online retail sales shot up. I mean, we've seen that. I just saw a headline a couple weeks ago that Black Friday had their biggest ever online sales for Black Friday weekend. And then in-person stores had their worst daily sales since they started tracking Black Friday sales.
Which is odd because Black Friday was more days. So, I mean, just by sheer amount of time potential, you probably have a bigger scale or sale. So
so just those type of things. But right now in the second quarter, we knew that was coming. But the third quarter bounced back so quickly. The economy just rebounded a lot faster than I ever anticipated, and we saw. Obviously, Q3 GDP was up 33% over the second quarter. So that we had a negative 30%, and then we had a positive 30%. And so we went from having the worst quarter ever in GDP in U.S. history, because like I said, GDP was invented after the Great Depression, to the best quarter ever. I mean, we just went from worst to best within a matter of a month, is what it seemed is, and that's really what happened. And so going into that third quarter and seeing that rebound it was pretty sharp. And so as we kind of look and see what was going on there, you kind of think, okay, well, I guess I was going out to eat more, but not really. We weren't really doing many things differently, but under the hood in the economy, there were a lot of different things that were moving that helped that GDP grow significantly. And
again, too, I think for those of you that aren't watching this on the podcast, we will have Zach's going to share a lot of reference material with you that will be on our show notes and on the landing page that we have. So if you go to planforeverything.com, we can look at that and obviously, get you some more information. And you can also follow links through the YouTube channel as well. So, and I think too, to talk about your point a little bit, because I think you talk about GDP not being invented before the Great Depression. The last time that we had like shutdowns like we've had was in 1918 with the Spanish flu, which obviously predated the Great Depression too.
Yeah.
So we've never really had anything like this that completely shut down the country. And I think, to your point, even though we look at kind of the third quarter and say we didn't really do anything different, just returning back to normal, with some like being able to leave your house and go to the gas station, drives oil up, so it's just when you have such a sharp decline in a very quick amount of time, it doesn't take much to stimulate a dead economy,
Exactly. And we saw that stimulus bill. If you want to talk about like stimulating the economy, we knew in real time that this was happening. Back, the GDP figures actually for like the second quarter GDP doesn't come out until July, so there's a little bit of a lag. But we knew in real time that the economy was bad. We saw it happening on a day-to-day basis. We saw March Madness get canceled, and then everybody's like, "Whoa, that's a big hit." And then
this is real now.
Yeah, and then you see the NBA season gets canceled, and you see all of these things happening, and you're like, wow, it doesn't take a genius to know that March Madness getting canceled costs a lot of people a lot of money.
Yeah.
And so those type of things happening in real time, I think, is something, like you said, is just it's unprecedented. But on the flip side, there were a lot of positive things happening in real time. Like I said, the stimulus bill having increased unemployment insurance for those who are unemployed. You got that $600 a week. That actually led to increasing wages. Yeah. So we were in the middle of a recession and wages were increasing. And those two things just have never happened before.
Yeah, because I think they didn't do a good enough job of probably adjusting that to, Tennessee got a lot more benefit than San Francisco, or somebody. And it's just
people here got a big raise, and people in San Francisco were still hurting because you can't pay San Francisco rent on $600 a week.
Right.
So that is a lot of money to most people, but in San Francisco, it just doesn't go as far.
Yeah.
But that is so unprecedented. As wages go up when we are in a recession, and really in almost, like I said, depression-like categories, we had millions and millions of people without jobs. Yeah. But we see that happening. You're like, well, that's really positive. Well, one of the other things that was happening is we had unemployment that went up to, we had the highest unemployment rate ever.
Yeah.
And then immediately unemployment went from 13% about 3% to 13%, and then back down to 6%. That's millions and millions of jobs that we are creating and destroying in, we're talking 2-3 months of a time frame.
Yeah, because you look at the wave that was, because we were at historically low unemployment rates right before we went to historically high unemployment rates. And it's just to see that wave in such a short time frame. It makes sense, but at the same time, it's just odd to see those happen.
When you look at this chart that we'll post on the landing page, you'll see that prior to other recessions, the unemployment rate has gone up pretty dramatically, but it has been a lot slower of a move. It hasn't just been we go from 3% to 13 or something like that. It's been, we go from 3% to 5 to 7 to 9, and it just starts creeping up a little bit. But like you said, it happened so quickly.
Yeah.
One of the reasons, and I'll put this chart up too, is that this recession is a little bit different and the economy is a little bit different. Is in prior recessions, the two parts of the economy, which is goods and services, so those two sectors, goods have always been hit harder than services. Goods, people stop buying goods, they stop shopping, they stop discretionary purchases. That seems to be one of the primary ways that people can cut back during a recession. Well, this time, almost all of these jobs that we lost were service industry jobs.
Right.
So all of those servers and people who work in restaurants who lost their job in March, as soon as the restaurant reopens in June, they've got it, and then maybe we have, like Chicago, shut down restaurants again, so now they've lost their job again. Yeah. So we're going and playing this push and pull with people who are, 1 week may have their job and the next week may not. And so seeing that discrepancy and seeing how that is so much different this time, it kind of explain, okay, well, if these people are unemployment, they're getting a raise, because if you're a server and most of your raise comes from, or most of your wages come from tips, then any hourly increase is going to be a pretty substantial raise for you. So seeing those things kind of work themselves out is pretty interesting here.
Well, and I think too, I was listening to somebody talk about how, in the long run, you're going to see some situations where, like take the restaurant industry for an example, the barrier to entry to make a restaurant is just you having an idea and doing it, so somebody was talking about how like there was already something like 25% more restaurants than there really needed to be, on the space. And so you're going to see a lot of shifting happens like any time that we have recessions where, more needed or, justifiable restaurants, if you want to use that, because of demand. But then also, like in the hospitality space, you're seeing more businesses or more hotels that were just conference driven that's really dried up, starting to shift toward more leisure focus. Like here locally, Opryland, is a big convention center, and what they did, which I don't think they predicted this, but it positioned them very well. But they put that water park in Opry Mills, and so that's really kept their business going, in the midst where they weren't able to do any conferences when shutdowns were at their height and things. So,
and who knows when that stuff is going to come back with conferences.
But you're going to start seeing that, in that one specific thing that's going to have a longer term effect than even if we do get a vaccine. You're going to have that be something that is a driver for those so that they diversify their channels, I guess, if you want to call it that way.
Yeah, extreme numbers extreme economic environments and measures like we've seen always spark some kind of innovation, and it just takes a long time to figure out what that innovation is. But like you said, maybe you see a lot of these things shifting in the in that hotel and hospitality sector.
So as we look here, I do want to. Do you have anything else, Zach, that kind of lays the foundation for what we're looking at? With the economic numbers now, because like when we come back from our break, we'll kind of hit where are we at and where are we going. Anything else you wanted to point out for?
No, I think the most exciting part I want to save for the second half, which is the housing industry, and that affects virtually everyone.
Right.
So talking about that I think is a trend that's going to happen for the next 10, 15 years, but we'll talk about that.
Yeah, because I think the big thing that I hear you saying with the economy is like a lot of things happened, but a lot of things made sense because of what was going on at the time. But now it seems like we're starting to get into a period where, all the logic that went into what was happening behind the scenes and behind the numbers is starting to shift into, okay, well, now we're seeing numbers that don't predict what's happening, like economic numbers that are terrible, but yet the market is flourishing. And how those things are interconnected. Because, for all intents and purposes, I think a lot of people from a market perspective, it reflected some of the opinions of people where, yes, we're down because we have a pandemic. And again, oil prices, had a lot more to do with that. We've talked about that several times. But then whenever things opened back up, you saw the broad economy, or not the broad economy, but the broad markets respond to that because people, I think, were, thinking that this made sense, that everything was opening back, the market would return. You also saw some people that probably had some cash on the sidelines that went into the market, and took advantage of a really good buying opportunity that, we didn't know that we would have over a 4-month period, And
the markets reacted quickly, but when you look back on it, at the time it didn't make any sense, but when we look back on it, they got it right.
Yeah.
They overreact. We thought it was a big overreaction, and then it turns out they were like, no, we're going to draw down 30% in a 4-week time frame because the economy is going to be really, really bad. Yeah. And then they bounce back, and everybody's like, what? It's crazy. We're in the middle of a pandemic. Why are markets bouncing back? And then you realize that this is just our new normal.
Yeah.
That we can recover. We just have to make some adjustments here and there. And the market really reacted to that in both the down and the upside a lot quicker than any of this economic data or, anything that my head could comprehend. I was like, what is going on here? And then you see that now. Looking back 6 months, it seems to make sense.
Yeah, and I think it does go to, like in summation there, making sure that you do have a well-diversified plan and sticking to it whenever things are obviously unpredictable. Like I know for the people that we've talked to, the ones that just stayed with what they were doing benefited the most than people who, got scared and they sold out, because that's just one of those where kind of like where we're at now, you don't get opportunities where you have all-time highs in multiple asset classes that people invest in. And so it is one of those things where, as we move this conversation into kind of where are we now and where are we going, it is a time where you want to be able to have a conversation of, is this the right allocation for me over the next year, 5 years, 10 years of my life? And if not, now's a great opportunity to maybe capture some gains, redistribute, and do something else.
Right.
So as we look at that, we've kind of set the stage, a little bit of foundation for where we have been. As we come back from the break, we're going to talk about where are we at, where are we going with the economy. So thank you for joining us for the first half. We look forward to kicking off the second half soon. Back and Forth will be back and go forth in just a moment.
Are you nearing the age of retirement? Is your 401k not looking the way you'd hoped all those years ago? Retirement is supposed to be a time to relax, a time to live. Here at Blue Ridge Wealth Planners, we strive to provide that service and opportunity. We can help you form a plan that will maintain and grow your retirement savings so that you can achieve what you envisioned when you originally set out on this journey. To see where you sit and what you can do to stand again, visit planforeverything.com. That's planforeverything.com. Blue Ridge Wealth Planners. Let us plan for everything so you don't have to.
Welcome back to Back and Forth with Blue Ridge Wealth Planners. As always, I am John. This is Zach, and we did, for the first half of our podcast, reminisce a little bit about a very ugly time in both our economy and our lives with this 2020 year that we've had, but also, it's had some opportunities for people. And I think, as we look at it now, seeing where we're at today, but also where we potentially can be forward or moving forward into 2021 is something that we definitely want to make sure that we're always aware of, and something that Zach's going to definitely, walk us through as we kind of finish off the second half of our topic today. So again, Zach, go ahead and start us off with, I guess, your most noteworthy things or most excited about things going on. So
I think it's exciting because it affects a lot of people, and that is the housing market. I mean, we saw that happen obviously in a negative way in 2008. But now in a positive way, the housing market has been incredibly resilient. And I think that is one of the things that the pandemic just kind of kickstarted, is that there's going to be a lot, in my opinion, a lot of generational buying demand. Yeah. Millennials are now getting to first-time home buying age. Millennials on average are starting families a little bit later. So I know that has kind of been delayed as far as getting into the housing market. But now during the pandemic, when everybody was forced to be at home, I think you had a lot of people who were in their late 20s, early 30s saying, I would rather be quarantining in a 2-bedroom house than a 700 square foot studio apartment.
Right.
I think that really kickstarted this, what I believe will be a generational buying spree for millennials over the next 5-10 years for the housing market.
And again, you talk about kickstart, with interest rates primarily.
Interest rates, that's the other component here. Is I think that millennials have been gearing up to buy houses. They just it's not as important to them as it has been to previous generations, as we've seen them stay in apartments and value flexibility a little bit. But I think that we saw that they still want that, and a lot of that, like you said, was kickstarted because if interest rates are now, mortgage rates are 3%, you can afford so much more of a house than you could when mortgage rates were 5 or 6%.
Right, or the same house with a much lower monthly draw to you.
There's a trade-off there, and so we saw that happen with the economic data. That's how we kind of tie this back into 2020 and what was going on in the economy. Was we saw, pending home sales. Let's see, I have this chart here. Pending home sales during the month of November were up 20% from last year. That's not a month over month. We're not looking at March to November. We're looking at November 2019 pre-pandemic to November 2020. Mm-hmm. That's huge. Yeah. We're looking at that's an enormous number, and so
2019's numbers weren't bad.
No, we had it.
It was a really good year in housing too. So
it's a normal to like healthy, good economy, and then now we're looking at this pandemic economy, and housing is just skyrocketing. We're seeing houses, anecdotally, houses in my neighborhood are selling day of. They're selling within a day or two. And so we see that and you're like, well, that's an interesting thing. Let's see if this is playing out across the country. And it really is. How that actually affects most people is their housing prices. Housing prices from last year to this year are up almost 7%.
Yeah.
So now your house that was, worth $100,000. If you have a house that's worth $100,000 a year ago, it's worth $107,000 now. So you made $7,000 just
without doing anything.
Yeah, exactly.
Staying there longer.
Yeah.
And if you count all this money that was spent at Lowe's and Home Depot remodeling that same house,
exactly,
that's not even in that 7%. So yeah, I mean.
But those type of things that affects a lot of people, and so that could affect somebody who's looking to, if you're in retirement and you're like, well, I want to downsize now. All the kids are out. I want to look at maybe buying a different home. Well, you just made a lot more money trying to sell your house during this housing environment. And so the reason I think this is so important is because I don't think that this is a one-off. I don't think that this is the unemployment rate going from 3% to 13% back down to 6%. I'll be shocked if we, outside of coronavirus and this pandemic, I'll be shocked if we ever see that happen in such a short time frame again. But I think that this housing story is really just starting to pick up with a generational movement into housing. And so the other thing that kind of sparks this is housing has finite resources. There's only so much land that you can build a house on.
Yep.
And so that scarcity of supply, depending on the region that you're living in, can also boost that home price even more. And so seeing these things can be a big boost to that net worth going forward, but it has been so far, and we saw that in 2020. Is just like you can have, like I said, $7,000 more just because you stayed there.
Yeah.
I think those things are really important.
For some of the people that are pessimistic in viewpoint, which I wouldn't qualify myself as, but, as you look at it, it's a great time to buy a house or a great time to sell a house, not buy a house.
Yeah, but if you're selling your house, a lot of times you are also buying. So keeping that in mind.
So, you've got a cost. You've got a great opportunity on one side and then a bad situation on the other. And so, what you're saying is the housing bubble that a lot of people feel like we're in, because it's not pandemic related that we've had really good house numbers. Like people were saying even before that, like, man, we've got really, high prices on homes and different things for the equivalent side. You think that's going to be something that will continue on because now you've got a younger generation that's never even had a house. They're entering the marketplace.
I think there's this whole new demand coming to the market that wasn't there, and it's been in apartments. We've seen apartments flourish. Apartments have done extremely well. They've been, some apartment complexes are at 100% capacity. You see them, apartment complexes are full, so everywhere you look, it seems like you're seeing a new complex going up. So we've seen that, and I think that millennials aren't just moving out of apartments in droves, but I think that all the demand that caused apartment buildings to be so full and have such high capacity and rents to go up every year, some of that demand, if it just starts to make its way into housing market, I think that can be a huge boost, a longer term boost for the housing market.
So you would say that you think the demand coming out of apartments is kind of matching up with the demand going in, because you're almost seeing where, for previous generations that apartment buffer didn't really exist.
Yeah.
It was just you stayed at home until you got married, and then you went out and you bought a house.
Exactly.
And then now you're seeing that apartment be the buffer there. But as people are getting, now more of an incentive to leave, you've got another generation of people that are kind of entering that buffer themselves, and trying to put themselves in. I would say when you look big picture wise, it seems like this younger generation has more of a mindset toward finance and savings than a lot of previous generations do, because I think a lot of people are realizing that the safeguards of Social Security and some of those things may not be there, and having an awareness of. Now, saying that, you can also have people who are completely responsible with money too. That's present everywhere. But
I think financial education in the last 50 years has just improved so much. We're sitting here talking about these things, and 50 years ago, we maybe kind of knew what GDP was.
Right. Yeah, and I think that's probably happened too because of technology making the individual have so much more capabilities of what they do with their money and more say-so and more control. And I think that ownership too is probably going a long way as well.
Right.
But that can maybe guide us into where we're going. I don't know if you had any more points on the.
No, I think that the housing market, I think, is going to continue to be a trend for as we look to 2021. The biggest thing, and this sounds like we're just kind of beating a dead horse, is the stimulus package that may come in January or February is going to be huge, because we're looking now, the stock market has rallied in the last month or so and is at all-time highs right now. Depending on when we're talking about this, it may be at a new all-time high in this very second. but it's all because of this vaccine that we're expecting.
Yeah.
We've had 3. This is actually the first Monday in the last 4 weeks that we haven't had some positive news for a vaccine on a Monday. We've had 3 Monday. The last 3 Mondays we've had like positive vaccine news when I woke up on Monday morning.
We're just trying to get rid of the Mondays, the stigma,
Yeah.
We're also going to survive.
So that's what we're going to look for, and that's really going to help the economy open back up. Because like we said, all of these service industry jobs, if we can have a widespread vaccine, we'll see a lot of those jobs return pretty quickly, I think. As long as, there will be some restaurants, like you said, that will have closed permanently, or some of those businesses that unfortunately will have to shut because they just couldn't last this long period of time with such low, such decrease in business. But I think that as we look forward, the vaccine is going to continue to be the story until we have it. I think that we're just going to have to look at that because that's what's going to be the trigger for the economy to open back up. But until then, we're really looking at potentially, if we're looking at the second half of 2021 getting this vaccine, we've still got 6 months in the first half of 2021 that we need some kind of stimulus for all of these businesses that are going to remain shut, or all of these people who will have their jobs that still haven't come back.
And I think, too, we're already seeing the numbers from Thanksgiving and increase in cases that will continue probably through Christmas. And so it's one of those where it will be interesting to see what happens if there are more shutdowns that are put in place, if people will handle them better knowing that there's a vaccine on the horizon, where like March, April, we didn't know what the heck this was. Like some people were ignorant of, it being a real thing. Some people were scared to death. I think we know a little bit more about it now. And the hope that comes from a possible solution, it'll be interesting to see how that affects both economic data and market data, you know. Because I think, like what you said, the market has responded to vaccine news. I think it's also responded in some ways to the hope of a gridlocked House and Senate, as well, even though that's not a certainty yet until there's an election in Georgia. And even then, even if both of the seats went Republican, that's not a big enough majority to really, toot the horn, so to speak, when it comes to possible changes in the new administration. So I think that both of those things are combining. But I'm curious to see in 2021 if these numbers maybe continue, or maybe vaccines come out and they're not as, I don't want to say effective as they say. Because like when you have news stories of this being 90% effective, like you're expecting this to be a sure thing, and it may not turn out. And the concern that some people, and again, this is all, hearsay at this point because nobody really even knows what this thing is, more than anybody else does. But I think it's one of those where, as we look at it, some of the people have said with the vaccine, you may have COVID-like symptoms. And so then it's just about how we balance out, the who's actually got it versus who's getting, better. And it'll be interesting to see. It's
a big unknown, but that's why I think regardless of what happens in the Georgia runoff election, it seems almost like an almost certainty that we will have a stimulus package at some point.
Yeah.
And
no,
so
I think that's kind of floating outside of here.
No, exactly. So that stimulus package, getting through all of that uncertainty, because like you said, there were reports that we might be getting the vaccine by the end of 2020, and healthcare workers and frontline workers might be starting to see that. And so, maybe that'd be great, but the FDA still has to approve it. We still have to distribute this, and we've got 3 or 4 weeks to go now. So seeing that and watching all those things play out to get through that uncertainty, we're going to have this stimulus. So for the economy, looking at that and then trying to project and say like, okay, well, we've got some stimulus, so we can kind of rest easy and say, let's focus on the vaccine and see where that's going to take us. Because like you said, it is so unknown right now, and we've seen things happen so quickly that balancing these two things, from the stimulus to the vaccine, is going to be the story for 2021.
Yeah. Anything else that you see kind of economically to watch for right now? Because what I'm hearing from you, just from a fundamental perspective, is we're not at a place where we were in March, where if we do have some types of shutdowns, that we're going to have the crazy responses to it, I think. Do you feel like that's maybe accurate? Or
I think that the shutdowns will hurt. The problem that we're going to run into now is in March and April and May, we had the the payroll protection program, and so that helped a lot of businesses stay afloat. So we saw Chicago just close indoor dining again, and New York's flirting with that same idea. And so if we go through this, if New York closes and other places close, my biggest worry would be, in absence of a PPP program, will there be businesses that shut for good?
Yeah.
And I would look at that and say, like, okay, we had a lot of businesses that took advantage of this, and it helped. I mean, that was designed to pay for payroll and rent and things that just literally kept the lights on. You could use it for utilities. And so not having that is going to be really tough, because I wonder what businesses will actually close. I think people themselves, we kind of know what we're dealing with now. We knew, and we have an idea that maybe it'll be a little bit more short-lived or something. That's what we're seeing, is we're not seeing like, oh, we're going into a 2-month lockdown. Maybe this is like the UK. They locked down, and they had everybody at a stay-at-home order, and they did it for 4 weeks. Mm-hmm. So maybe if we know that there's an end point here, there's a little bit more optimism. But I would be worried about that, is just absent of a PPP, what businesses are closed for good? What's the long-term unemployment look like? This month-to-month thing is, we've seen that play out. But what does this look like if we go another 6 weeks without that PPP? I don't know.
Well, and I think too, what could have happened with like the PPP is it was like a lifeline for some businesses that maybe weren't prepared, but it maybe delayed some inevitable facts for some people. Like we talked about with restaurants, where there may just be too many restaurants to be supported by.
Or there's some restaurants, like if you're a pizza place, to go doesn't really change.
Right.
You lose a little bit of business, but then if you're a fine dining place, maybe there's all these levers. Those are the type of levers that when you look at, you're like, well, it's really hard to know, because when you're like you said, I think people are prepared for a shutdown. I think like just because we know what's coming, and that hope of the vaccine might make it a little bit more bearable, I think.
Yeah. Well, and I think more than anything else, when you talk economically, it seems like what the first wave of shutdowns did is it sent a warning shot out to businesses saying, you better have diversification of how you're, getting your revenue, and you better make sure that if this happens again, you have a good response to it. Otherwise, the people that are not going to have the response to it may not weather it without the PPP. You know what I mean? So it'll put more of a value on businesses that can have the flexibility to change, like there's going
to be innovation that comes out of this dramatically.
But it always does. I think sometimes people, your financial people that you work with, probably have told you that a correction could have happened. They just wouldn't have predicted it would have been a pandemic that, had no symptoms and scared to death everybody.
4-week period.
Right. But it's one of those things where the fundamentals of the economy, as we look at it, are still a little out of whack from like still having pretty high unemployment as the way we look at it. But in the short term, look a lot better than they did. Like if you pulled the data out that we have right now, any year, in the past, you'd be like, oh my gosh, what's going on here? But in the midst of such a turbulent year like we've had, we've just kind of seen a little bit of everything. So we're not really surprised anymore. I don't know if you want to put it that way, but
I would say I want to float this out here too, because this is something that I've just been thinking about too, is this is more of a Zach Hill fun theory to think about.
Yeah, we'll wrap up with
This is my fun theory is, as we look forward to the economy and fundamental changes that we think, like you said, innovation can come out of this. I was saying this on Fridays. I made an appointment at the DMV, and I was there for less than 10 minutes. What an innovation. That never would have happened without the pandemic. I would have been at the DMV for 3 hours.
Yeah.
But one of the things that I think is going to be looming over the economy is going to be, as we think about Christmas, we think about Christmas shopping, is this really, is this the death of the traditional shopping mall? That has been coming for a long time. Malls have been going out of business. We've seen a lot of malls going down. And so we've seen Amazon do phenomenally well and online shopping just taking off. So is that alongside housing one of these things that we see malls turn into water parks, turn into all of these things that start to happen? And I think that if I was just thinking about what's an innovation that I see happening potentially right now, and it's going to be this shift in these big pieces of real estate and what's housed inside of those.
Yeah, no, I've had that theory for a while now because I think what you're going to see happen from a office space perspective, we've talked about this, is, you've got office buildings that may not have the corporate tenant anymore, but may offer up smaller offices for people that don't want to work at home anymore, but still want to have a workspace, so I mean,
exactly.
It still may be office real estate, but at the same time, it may shift into just a different way to do it. But I think what you're going to see there from what you were talking about with the shopping mall is you have to offer something that's an experience that people can't get online. Mm-hmm. If you're going to survive that and be a brick and mortar, you've got to have amazing customer service, an amazing client experience that makes people want to leave their basement and go shop there instead of just getting it delivered to them and then mailing it back if it doesn't fit. So yeah, it'll be interesting to see how the shift of in-person business happens to where it is more experiential, more than anything else, I would say. Because, I mean, we've even seen some of that, in our space where, trying to have a really good client experience, trying to have a really good interaction and service model is something that I think is going to be the lifeblood of businesses that are able to thrive through this. So, but anyway, that's a little picture of where we're at economically. Hopefully, if you do have any questions, let us know either through, we've got, I guess, resources, info@BlueRidgeWealth.com. You can ask any questions that you have, and we'll definitely get back. May even inspire some show topics because, in the second season, we've got the episodes mapped out, but we do have some flexibility based on, obviously, things that we have seen this year changing a lot. You don't want to have such a tight schedule that you can't allow for very topical, very timely conversations like this one and others. So thank you for joining us today. Look for more during Season 2 of Back and Forth with Blue Ridge Wealth. But I'm John. This is Zach. That's all we have today. Thanks.
Investment advisory services offered through Blue Ridge Wealth Planners, a registered investment advisor. Securities offered through Madison Avenue Securities, LLC, member FINRA, SIPC, MAS, and Blue Ridge Wealth Planners are not affiliated companies.